The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Spouses Talking Houses with husband and wife real estate team Jennifer and Brian Frost. Everything you want to know about buying, selling, investing, and owning property. So let's get real about real estate.
And today we've got two guests, and we're going to get real about mortgage qualifications and approval. Who makes the rules? This is a special at-home Zoom edition of Spouses Talking Houses as we are social distancing. And I'd like to introduce our guests. We have Joe Coulter from RMS.
Hi, pleasure to be here.
Thank you. And we have Matt DePippo, also from RMS Mortgage.
Hello, thank you for having me.
You're welcome. Matt works right in our office, so we can have people do one-stop shopping and talk to Matt about the money and then talk to Brian and I about the houses. So we appreciate you joining us today. So I'd like to talk a little bit today about, where does mortgage money come from? So he who has the money makes the rules, right? And then what does an underwriter do? Where do guidelines come from? How are they changing? We've got quite a bit to talk about. So first of all, I'd like to know from either Joe or Matt, you can let me know who's interested in answering this one. Who are Fannie and Freddie? Are they just our crazy aunt and uncle at the Thanksgiving table or what?
Matt, why don't you answer that for us?
So Fannie and Freddie, the best way that I would describe them, they're aggregators that pull together what will eventually become mortgage-backed securities. I think really their main job is to provide liquidity in the housing market and allow lenders to continue to lend out money. And so I think it was 2008, Fannie was bailed out by the government and they were delisted. So now they're quasi-government entities. But yeah, that's that. They don't necessarily, they back the loans. They don't necessarily provide mortgages. And so their main role is to kind of be, like I said, that aggregator. That's the bridge between, us loan officers, mortgage companies, and the mortgage-backed securities that are eventually offered to the public. So that would be my best description of it, unless Joe has anything to add or subtract from that.
Yeah, that's basically about right, is that they guarantee and back mortgage-backed securities, but they don't actually provide the money themselves. Getting involved in actual lending there is a humongous regulatory burden. It's very complicated and complex, especially when you're dealing face-to-face with people. So the government and Fannie and Freddie, that's not a business they want to be in. So they let us and others make the loans of which they back. It's a lot less labor intensive for them, but it's incredibly capital intensive, which is why they have the full faith and credit of the government. You can just imagine the amount of dollars required to make and back mortgages is just humongous. So they're one of the few entities really in the world that has that kind of capital in order to be able to do that.
So when I think most people think of a home loan or a mortgage loan, they think of that movie, It's a Wonderful Life, that was set during the Depression. And there's the local banker who has the deposits of the local citizens, and then they turn around and make loans to the local citizens with those assets. And that changed years ago. I think the 70s was when Fannie and Freddie were created.
Yes, exactly. And part of the reason was you just needed more money. So
Right.
your local bank does still make those loans. There's really three ways to get a mortgage: one's through a broker, one's through a correspondent, and one's through a local bank. Your local bank or your local credit
Right.
union. It takes a lot of money. And so I think back then, house prices really started to increase, sort of as a byproduct of availability of money. And so local banks have a certain appetite for that. It's just part of their portfolio, their investment portfolio, so to speak. But your local bank, has assets of $100 million or $200 million or $1 billion. Doesn't take a lot of mortgages to get to that level.
And once you guys lend the money, then they get packaged into pools by Fannie and Freddie, which, by the way, their nicknames based on their acronyms. So FNMA and I can't remember the initials for Freddie, but anyway, once they're pooled, then they become a bond on the bond market. And so people in retirement accounts and pension funds and et cetera invest in those. Is that correct?
Yep.
Are those Ginnie Mae bonds, or is that a different bond?
Well,
that's a good question. That's okay. Go ahead, Joe.
Again, you're right on with the acronym. So there's different classes and pools of mortgages. So Fannie Mae and Freddie Mac deal with what's called conventional type mortgages.
Yep.
Ginnie Mae is a separate entity that helps out with a sub package of mortgage offerings called, FHA loans, which I'm sure everyone's heard of.
Oh, okay.
As well as
Yep.
veterans loans, and as well as USDA housing. So Ginnie Mae is kind of the aggregator for those three. They all get their own special entity because they're a higher risk loan.
Mm-hmm.
And so the government's more involved in them. They have generally people with worse credit profiles, lower credit scores, higher risk factors. And so they have their own sort of spin off. But essentially, yeah, they operate in conjunction, sort of, with each other. And then they're all, they produce bonds and sell them just like Fannie Mae and Freddie Mac does.
All right. So not to spend too much time on this, but basically when they package those mortgage loans together to be the underlying basis for a bond, the loans need to be underwritten to a similar standard. Is that correct?
Yes. And so each one of these entities, although they operate somewhat in conjunction, they're all, in essence, they almost compete with each other.
Mm.
And so they'll make changes, and they're not quite a monopoly, but they're not quite 100% competitors. But we'll see things like Fannie Mae will make an underwriting change to allow a certain percentage higher for loan to values on, say, a second home purchase. Freddie Mac will take notice, and they want those loans, and so they'll say, okay, well, according to our risk metrics, we don't really want this, but we're also losing X percent of loans or of our portfolios going over to Fannie Mae. And so they'll make little concessions. So they are slightly different, but in essence, each one of them publishes a set of guidelines that they want loans to adhere to, that they're comfortable in their risk profile. I will tell you, underwriting is an art and a science because those guidelines extend tens of thousands of pages each. So it's a lot like.
So what does an underwriter do, Joe?
Great segue.
What you have to do is being a lawyer, where you've got to find what's pertinent and what the guidelines actually mean and how does it apply to your client. And a lot of times you operate without a whole lot of direction.
Yeah.
So the guidelines can be vague, and so that's why you'll see sometimes people will say, well, my local bank says no to this, type of profile, but you say yes, and someone else said maybe. It's not that they really have different guidelines, but there's different methodologies of thinking about those things, being more or less risk-taking according to how you feel as a company about that. And so some companies are known for being more conservative and some more liberal in that regard, depending on what type of organization you are. So banks are traditionally considered very conservative. So if there's any grayness to the guideline, or if they're not sure if that really fits in what they want to do, they're more than happy to just say, hey, maybe you're better off served by a broker or some sort of correspondent.
So RMS is a direct lender, right?
In essence, yeah, we're a correspondent. I mean, we're selling these loans off. We do service some of them, but essentially we're looking to turn around and sell them off, whereas a bank wants to hold those loans.
So the difference between a mortgage broker versus a lender versus a bank.
Matt, answer that.
Yeah, Matt, why don't you answer that for them?
Okay, so tying into what Joe said, with banks, they keep the loans on their books. So in some cases, Joe said that they're more conservative, but on the loan officer level of things, I have contacts and other loan officers that I associate with outside of RMS that may work at a credit union, whether it's St. Mary's or Eastern Bank or something like that. And because they are portfolio loans, meaning they service them and they keep them in-house, sometimes they're not held to the standard that Fannie Mae, Freddie Mac, FHA, VA put out there for guidelines. And condos are a good example of that. Non-warrantable condos. There are some banks, credit unions that have special products for that I wouldn't have access to because we have almost every product available, loan program and product available. But when you're keeping the loans, you have more flexibility in terms of guidelines. So it's a double-edged sword, in my opinion. They're probably more conservative on most things, but there are that specialty program or product where they can do the loan where I wouldn't be able to do that loan. And then with us, like Joe said, we take the loans and we sell them off. Which is then, to Fannie Mae, Freddie Mac, and converted into the MBS or mortgage-backed security. So that's my understanding and kind of summary of the difference between types of lenders.
So, Matt, if somebody does get a portfolio loan, they go to their local credit union and they get a loan that bank or credit union or what have you is loaning their own money, and they're going to hold that loan. They're not going to sell it. Are they typically able to get a fixed rate, a 30-year fixed rate loan?
Sure. Yeah. I can't speak directly to the different types of loan terms they offer, but I don't see why their loan periods or length of time that you could take out the mortgage would be different. So yeah, I guess the short answer would be yes.
But a lot of times what I'm seeing is that the rates are adjustable because they're not able to lock in the interest rate as if they had sold the loan. Does that sound right?
Interesting.
A lot of times on portfolio, I'll see a 3-1 or a 7-1 arm.
Matt, I'll jump in here real quickly if you'll excuse me. With those portfolio loans, it is traditional banking, like you're saying. It's a wonderful life. It's a bunch of guys and a bunch of gals sit around a table, and they all have a stack of applications, and they say, "Hey, what do we feel about Mrs. Johnson, Mr. Johnson, and this loan?" And then they go around the room. And they just say, "Yeah, okay, I like it. Okay, I don't like it, or I do like it, but I don't want to be lock our bank into a 30-year fixed rate mortgage because we don't know what interest rates are going to be like. So maybe in 20 years, whatever rate we give them today is a bad deal for us."
Right.
So they will say, "Hey, you know what? We wouldn't normally do this loan, but we'll do it if they agree to a 3-year arm, meaning an adjustable rate. At the end of 3 years, it kind of goes to market. So that makes a pretty good deal for us." And then they also sit around and say, "Well, what do we want to do for a rate?" And they're like, "Okay, well, how about 5%? The market's at 4%. We'll get, we build ourselves in an extra percentage point. We make some money, they get a loan, and then in 3 years we get to reevaluate, where we stand with those things." So, which is why sometimes if they feel like things are a little bit outside, they want to price in their risk and price in their profit. So when they do that, that's when you end up seeing them looking to adjustable rates.
So another question that I have is if you're dealing with a mortgage broker versus a direct lender, is the difference primarily underwriting and how underwriting is handled?
I'll answer that it's a yes and a no, like everything, right? So with a broker, it's just like kind of like being in insurance, where there's different people out there who want those loans, but they don't want to deal with, just like Fannie Mae and Freddie Mac, they don't want to deal with the customers. The regulatory burden's too much, so they go to a broker. And so brokers are independent people who solicit mortgages, applications from people, and then they go and turn and place those mortgages directly with whoever happens to have the best fit, best product, best rate, best underwriting guidelines. And that file actually gets sent to them, and then the broker themselves underwrites them and clears the files and funds the loans. So it is a way where you can find the best deal, but also conversely, you're just one loan. So if you're the type of broker, they're usually humongous entities, and you're submitting your one loan. So just like if you're at your local bank, they all sit around and decide. If you go to a correspondent, they're funding the loan sort of themselves. When you're at a broker, those decisions are made without you, essentially. So over there, they say, yes, we like this. No, we don't. It's either approved or it's denied. But to them, it's one loan. So if you're trying to think from their point of view, if it's an iffy loan, why bother taking the risk for one loan when you've got how many tens of thousands of other loans? So that's the good and the bad part about, kind of using a broker.
As a listing agent,
and
oh, sorry.
Yeah, no, I was just going to piggyback on that and say I think that's why a company like RMS that Joe and I both work for is, in my opinion, a really great medium between the bank that's sitting with a bunch of people around a table making decisions, and then the giant broker where it's less personal. So I can go and sit with Joe and my manager and fight for a loan. Right. So I still have the flexibility to say, hey, this is why I, build a case. That's what we say is you can build your case for the file. And then you sit with Joe and they review the guidelines and eventually it gets to a management decision where they are weighing the risk and if it's something that we want to do. But I wouldn't necessarily have that, like Joe said, if it was a giant broker. I make a phone call and I get somebody in Ohio. So I was just going to say that was why having that ability is so great when you're local.
So for a refinance or something like that, I am super comfortable with mortgage brokers, and I know some mortgage brokers that I'm also really comfortable with. But as a listing agent, when I see a loan commitment come through on my seller's house, and that conditional commitment includes that third-party investor still has to approve the loan or has a final say to underwrite the loan, to me, that's not a real commitment. And that's my issue with a broker, is that they're the middleman and somebody else is making a decision. Whereas with RMS, like you said, Matt, you can go in and bring Joe a cup of coffee and be like, hey, do you want to talk about this sketch loan?
Mm-hmm. Yeah.
Is that what you have them with, coffee? No bribes, right?
What was that? I'm sorry.
No bribing the underwriter.
I've seen and heard a lot of Starburst candy and occasionally some cookies have gone a long way.
So Joe, where do all these guidelines come from? You mentioned that you get binders and binders of stuff. I mean, how does that work?
Yeah, it's all published online. Strangely enough, the guidelines for all of those Fannie Mae, Freddie Mac, FHA, they're all public and they're all online. So if you're ever interested in sadism or you can't sleep, go ahead and find them
exactly.
online. And good luck reading them. They're written just this is impenetrable language. So yes, they're all out there. They update all the time. We subscribe to these things where every day, almost every night, we get updates from all of them saying we're changing this slightly, we're changing that slightly, we're going to change these things effective this date. These things retroactively are being changed. It is a constant stream and pitter patter of guidelines that are out there that are changing all the time.
Matt, you wanted to add something?
Yeah, I was just going to say, as a loan officer, he said that it's funny because you can just go Google Fannie Mae guidelines, but good luck reading them. So earlier, and I had a conversation with Joe not too long ago, and it was kind of an epiphany for me because I enjoy learning and reading and being able to be independent and not have to rely, know what I'm talking about, be knowledgeable. And so I was spending a lot of time attempting to decode some of the guidelines and interpret them. And Joe and I had a conversation. He just asked me, why are you doing that? And obviously to get a better understanding, but he's like, it's different levels of understanding. And so I was getting bogged down in the nitty gritty minutia of it. And it was all futile to an extent because I could, last week I could have read a guideline. I'm having a conversation with the bar, especially now in the current environment that we're in where, the changes are probably hourly at this point. Joe, conference call after conference call going over the changes. So I could have an idea of what one guideline is, or my interpretation might be different than what Joe or how Joe interprets it. So yeah, I just thought it was funny that you can go read them, but good luck. It's really, it's not going to do you too much good, because ultimately it's going to come down to, it's a guideline, not a law or a rule, and it's the interpretation part is the gray area, which can make it difficult but also beneficial depending on which side you're on.
So I don't know if I have the acronym right, but what is a QM standard?
I'll answer. It basically means qualified mortgage.
Okay.
So they're usually lumped together, QM/ATR. ATR is ability to repay. So that was enacted in the wake of the last financial crisis. They came up with the what's called the qualified mortgage. That also is public, and that's about 1,100 pages. I don't really know anyone who's ever read it top to bottom, but we pay a lot of money to a lot of consultants who tell us what's in there.
So when I have a borrower and they are saying, oh my God, they're asking me for my toenail clippings and my dental records, I always blame QM.
Yeah, well, that's about right. The QM was enacted, of course, like everything. It solved and answered a question that wasn't being asked, and it solved the problem that didn't exist. It didn't address any of the underlying issues, but it gave a new framework to mortgages, good, bad, or indifferent. So you're right. It does actually specify a lot of different things and what you can and can't do to make it essentially a qualified mortgage. So it is tempting to blame the loan officer, and it is tempting to blame yours truly, the underwriter, but a lot of this stuff, it does come directly from there.
Well, underwriters and appraisers get no respect, right, Brian?
This is true for sure.
I thought QM gave lenders kind of a safe harbor so that if the loan defaulted in the future, they wouldn't go back to you and say, Joe, you guys have to buy back this loan because you screwed up.
Exactly. It did give them, give the lenders a safe harbor, but only if you follow those guidelines. And that's the rub. You're free to make a non-QM loan, but you are exempted. You do not get that safe harbor, and you are liable. So that's why lenders are like, the potential cost of being sued or being to cure these mortgages if they're later found to be non-QM and you escape that safe harbor, it's extraordinary. So that's why all the lenders are so focused on making sure that these loans meet the published QM guidelines.
I think both of you referred earlier to this being like being a lawyer and making a case, and that's how I look at it. Like if this loan goes south 12 years from now, somebody's going to open that file. And did you lay out a legal case, in essence, of why you decided to give somebody $300,000? Is that right?
That is exactly right. And it's scary. You're thinking like, okay, what am I going to think about this loan 12 years from now? When you go back and look at this, you're going to say, what was I thinking? Who was in that room? How did I do this? And so you got to make sure and that you trust who you're working with and why you did it, and that you got to trust yourself in the past, strangely, and you have to trust yourself in the future.
So what keeps you up at night, Joe?
It's exactly that. I've got a pretty good memory, but I'm touching, giving opinions, underwriting 800 files a year, 1,000 files a year. So I'm now at 7, 8, 10,000 files that I personally have done. What's going to happen if I do this for another 10 or 15 years or 20 years? Am I going to remember, what I put in there and why I did it? It's going to be pretty hard, but I mean, as a lender, you are on the hook. So that's everyone's worst nightmare is you give a 30-year mortgage and 27 years from now, somebody says, they go to foreclosure and say, hey, wait a minute. I didn't meet QM. I had my commission income was earned for 11 months and 29 days. It says right here in QM, in order to use commission income to qualify, it's a minimum of 12 months. So, and then you're like, oh man, now we're going to have to pay back. Are we going to have to vacate this mortgage? Are we going to be paying penalties? That's why everyone is so concerned that we do it right and do it right the first time.
What does it mean to vacate a mortgage? Does that mean you're buying it back?
to just wipe out the debt.
Oh,
So you can imagine how that gets people's attention, right?
wow. All right. So, Matt, can you just tell me, because when we think of a loan, we think, hey, I got a loan from so and so. But, what's the difference between the loan originator, the loan servicer, and then the underlying investor? How does that work?
Yeah, so actually, Barry Habib, who is a mortgage guru, I guess would be the best title, he sent out an article earlier this week that did a really great job. Even from, I'm in the industry, it did a great job recapping kind of what's going on. And in that, he broke down the servicer's role, which I learned some new things from that article. But basically, me as the loan officer, I'm talking to John or Susie Smith. My main job, again, in my opinion, it's going to differ depending on who you talk to, is to have a conversation with them, educate them, and to learn what their goal is. Because whether it's a refinance or a purchase, everybody's goal and personal situation is going to be different. And so I have all of these programs and products available to me, with their individual guidelines and rules and regulations. And so the conversation will be, hey, we've got $10,000 saved up. We're currently paying $1,400 in rent. We think our credit scores are this. And so I take all of that information, and then I try to find what the best fit would be. Whether it's FHA, whether it's a conventional loan program like Fannie Mae's Home Ready, low down payment, the quote unquote first time home buyer programs. And so taking all that information and educating them as we go, I'll pick the loan program, and that's when I'll send the pre-approval letter based on that. And which is why I have to have a certain level of understanding of the guidelines for each loan program, because it's not fun to make the phone call when it gets to Joe, and we're almost halfway through the actual transaction. We're under contract. The sellers are packing everything up. Everybody's gone. They gave the notice that they're not renting anymore. And then Joe says, hey, you missed this here. They're over the income guideline, or they're under, or they're, you didn't add this debt in, or something like that. And now it no longer qualifies. Not fun for anybody. And so I give Joe a lot of credit, because, I don't envy his position in terms of, being the last one to essentially touch the file before it's sent away. You can't pull it back, can't unring the bell once it's, sent out there. So he gets, as you can imagine, when a loan officer or somebody who is in, the sales side of things is going to potentially lose a sale, you're having your referral partners, i.e., the real estate agents, the borrowers, all very, very frustrated and angry at you. And then you turn around and, we're 100% commission, just like real estate agents. And so not only are we losing a deal for you, but we're also losing income. And so take all of that, anger and frustration and direct it to Joe, who is, he's essentially the messenger, the bad guy. I don't envy that. And now multiply that by, 30 loans a day, 2 pairs of agents and 10 loan officers and operate, it can get overwhelming. So I'll take all that. I understand the programs and products. I'll say, hey, I think FHA would be a great fit for us, based on how much you have to put down, what you want your payment to be, what your credit score is, send off the pre-approval letter. And then they go shopping, with a real estate agent. And hopefully a week or a month or however long or later we get under contract. And then that's when it gets shipped to the processing and underwriting side of things. And once it's through the process and we're officially cleared to close, that, and again, my understanding of how our secondary market department works, and how loans are sold off on our end, I'm not super familiar with, but basically, once they're sold off, a servicer, this is what I learned from the article, will actually pay for the rights to service that loan and collect payments. So they're paying the real estate taxes, they're paying the homeowner's insurance and answering questions. but they're not the ones who are actually backing it, because that's Fannie Mae, Freddie Mac, like we learned earlier from Joe. And so they'll pay a percentage of the loan. And from the article, I think it was 1%. And Joe, feel free to jump in and correct me if I'm saying anything that's not accurate, or fact check me. And so if you've got a $200,000 loan, they're paying $2,000 for the right to service that loan. The break even, again, from the article, was that they have to keep it on their books for 3 years in order for them to, start seeing a profit, which gets interesting and exponentially more complex when you have a situation like we're in now. We have a refinance boom, but you have a refinance boom where we're no longer able to continue to process the amount of volume, right? So in a normal environment, the servicers buy the rights to a loan. They keep it for 2 months, rates drop again, somebody refinances, they no longer have that loan, right? So now it's cost them money because they haven't got to that break even point. They normally would be able to just make up for that with more loans coming in. But right now I'm seeing that the refinances are almost completely at a halt, just because the focus is primarily on purchases and making sure people can get into houses and out of houses. And so that's causing a real issue, because they were also leveraging, instead of paying, cash for the rights, they would split it up and leverage a little bit to increase their profit, right? So now there's margin calls getting involved. Yeah, go ahead.
I just want to jump in. So for the layperson, the servicer is who we write our checks to. And
correct.
Through the years, I've had so many different servicers, and it'll change. And people will say, "Oh, my loan got sold," but in actuality, the loan might not have gotten sold. It was the servicing that got sold.
Essentially, yeah. The actual asset itself is, and for like you said, layman's terms, that's kind of the process for, the majority of individuals who aren't in the industry or in the financial sector, probably a little bit over their head, but basically. And it could be a challenge for me as a loan officer, kind of customer retention after the fact, right? Because now, hey, thanks for closing your loan. A month later, your loan gets sent to Freedom Mortgage, who would be a servicer, and now they think that, okay, I got to talk to Freedom is my mortgage company. I have to talk to somebody from Freedom, and so I always have to remind myself to tell people, like, hey, your loan is going to be serviced somewhere else, but I'm still your loan officer. You can still call me, ask questions. I can do a refinance for you. I can do another purchase for you. I actually had a client call me, and again, this is my fault, but he was like, hey, so and so, my loan servicer says that I should refinance, and I was like, you should. That would be great. You should refinance with me. And he's like, oh, I didn't know you could, do the same thing that they could do for me. So that was a good example on, a learning moment for me to. Make sure that I'm top of mind and reminding people that I don't go away. I'm still here, still your loan officer, and you can still reach out to me. So.
And I also run into servicer versus the underlying investor when people get into trouble. Short sale, foreclosure. Right now, they might be calling up and looking for some sort of forbearance or to postpone payments because of the COVID related stuff. And so they're talking to Wells Fargo or Freedom Mortgage or ABC Mortgage or whatever who's servicing the loan. And they're getting mad at that person who's on the phone, but the servicers don't make the decisions. It's that underlying investor who makes the decisions, correct? It's Fannie or Freddie or FHA or VA.
In terms of the laws that surround foreclosures and
so like if I have somebody who's in a short sale situation, I may be dealing with that servicer, but the decision will be made by Freddie Mac because Freddie Mac is the one who owns that loan.
I'll jump in that it depends, and this is a very touchy subject right now, and this is exactly the problem. Is sometimes the underlying owner of the asset says, okay, sure, whoever the servicer is, if there's a short sale foreclosure, they say, hey, that sounds like a you problem. You figure it out. You owe us every month. You owe us X. And then sometimes, which happened right now, the federal government has come out and said, hey, we're going to look into some forbearance programs, or you can defer your mortgage payment for the next 3, 6, 9, 12 months. that's all well and good, but the servicers still have to pay. The
Right.
servicers are still fronting the money every month, and this is causing a humongous problem right now in the secondary markets. And the servicers are like, wait a minute, that's all great, but start adding up how much everyone's mortgage costs on a monthly basis. That number starts getting incredible, that they have to front that money. And when are they getting this money back? I mean, do people continue to pay their mortgages? They just say, sure, 90 days from now, everything's fine. We're all going to be all set, or 6 months. Or do people say, hey, I really like not paying my mortgage payment. I'm going to stretch this out as long as possible. If it starts getting stretched out to 6, 8, 12 months, it doesn't take a lot of people doing this. 10% of the market, 15% of the market, where you have a serious problem now. You're now talking hundreds and hundreds of billions of dollars that have been advanced by servicing companies who don't have that kind of money. They weren't built that way. They were built to handle little hiccups here and there. Some people go in foreclosure, some people go into short sale. That's built in their profit margins. They're not built to front mortgage payments for 10% of their entire portfolio. So it's an interesting time, and we're going to see what's going to happen in the next 3-6 months.
So when people use the word uncertainty, I think that's exactly what Joe's saying. That's what the uncertainty is it's almost impossible to predict, one, what's going to come down, legislation wise and change, and two, how that's going to impact everybody else in the chain of, from the inception of a mortgage to eventually when somebody invests in it. And so it's one of the questions that was, is it still unfolding, or, is it what it's unfolding daily, hourly, the updates. So it's interesting to be in it and watch as it kind of, comes together.
So Joe, how is COVID-19 affecting guidelines right now?
Really interesting. We've been seeing updates almost hourly, and the government is coming out and it's starting to trickle out and say, for good and bad. They're shortening, documents are usually good for a certain period of time. Bank statements, pay stubs are usually good for 120 days. They're now making announcements that they want to cut those timeframes down to 60 days, which is more of a hassle factor for the borrower. You apply, and we ask, like you said, for your fingernail clippings and your pay stubs and your tax returns and everything else. But now they're saying, instead of getting those things once at the beginning of the process, you find a house and then you close, they're saying every 30 days, every 60 days, we want to see new documents. They want make sure people are still at their jobs, at their rate of pay. Usually you verify it during the process, and then within 10 days of closing, make sure you're still there. They now are issuing guideline updates. First it was, 5 business days now between closing. Now they want it done within 48 hours. Now they're talking same day, and now they're talking after the closing. They still want people verifying that they're still working. So they're also very worried that, it's all well and good to give people these mortgages. Yeah, we all know there's an end date, but who's going to pay the piper? So if a bunch of people don't make their first mortgage payment, they have a serious problem. So these guidelines are starting to reflect that uncertainty, and it's a little bit of a wait and see game where Fannie Mae will say, okay, we're going to do this. And then Freddie Mac reads the updates and they say, okay, that sounds like a good idea. We're going to do that. And then FHA reads that and they're like, I don't know. We feel a little bit worse about that. So we're going to do something a little bit more conservative. And then it just starts this circular logic of VA reads that and they're like, oh, wait, FHA said that. Oh, we better come up with something comparable. So it's been updating, and I do mean hourly basis, where we'll get corrections. There'll be an official notification that goes out. An hour later, we'll get a clarification. An hour later, we'll get something a little bit different. So it's been a daily occurrence for about the last 10 days.
I know that just in this last 2 weeks, I was on the phone with different loans that were in process saying the appraiser hasn't come out yet. There's been a stay in place order. What's going to happen? Can we do drive-by appraisals? What's going to happen? And the answer would be like, we don't know what's going to happen. And then all of a sudden, Fannie Mae announces, we're going to start doing drive-by appraisals, and everybody breathes a sigh of relief. But that is them taking on more risk as opposed to mitigating risk which sounds like what's going on with making sure that people's employment and cash flow and cash reserves are better than they were before.
Yeah, so it's strangely like more liberal on some things and more conservative on other things. Like you said, they finally just released that update saying that the appraisers don't need to physically go in the property anymore. So that is riskier for them. You don't know what the condition of the property is. It's hard to measure, the property and get accurate counts of things and how things look inside. But also more conservative, continued update bank statements and pay stubs and employment. So it's been a strange seesaw about what they seem to be concerned about.
So are there 4 C's of credit approval for a mortgage, or are there 5 C's? Because I was driving me crazy the other night trying to remember what they were.
No, I'm gonna have to try and remember them. Credit, capacity.
I can help you out.
Do you know it?
Matt.
He was on it. He's got one more left.
Capacity, 4 C's, right?
That's it. 4 C's. Yep.
Collateral.
Capacity, capital, collateral, and credit.
So when you are underwriting a loan, those are the 4 main areas that you're looking at, correct?
Yes, exactly.
So can we just sort of define each of them real quick then?
Sure. The big one that we all know about is credit. Mostly there is a credit report. It gives you a score. A lot of things are score driven because that's the easiest thing to quantify. So products will say minimum FICO score, which is the credit scoring agency. Minimum credit score is 680 or 720 or 710. And then there's a subset in that credit section of taking into account the score, but also they want to look at, have you had any bankruptcies, foreclosures? Have you been delinquent or on mortgage history? Being delinquent on a mortgage is a lot worse than being delinquent on a credit card. Yeah. Being delinquent on an installment loan is worse than being delinquent on a revolving account. So guidelines might also say a minimum of a 680 FICO score. In addition, no bankruptcies within 6 years. All mortgage debts had to be paid on time the last 24 months. All installment debts had to be paid on time the last 36 months. All credit revolving accounts had to be paid on time for 12 months. So there's sort of a 2-factor part of the credit. That really hasn't changed for the most part with the current environment. We have seen some sort of uptick in minimum credit scores for some products, but not much of a change there. As far as the other items, there was a slight change to the appraisals, which we noted that the appraisers, for the most part, don't need to go inside the houses, so they can either do essentially a full appraisal but not inspect the property, or a full appraisal and drive by the property, just not go inside. So there hasn't been a lot of change there. Capacity is essentially what we would call debt to income ratio, all your total debt in relationship to your total income. That also hasn't really changed, surprisingly. So that's been okay. And we haven't seen any changes to cash. How much, what do you have available? We haven't seen any changes to minimum requirements for down payment, for loan to values. All that stuff seems to be pretty stable. So for all of the noise and a lot of the changes happening, the underlying credit decisioning hasn't really changed, which to me means there's an overall thought that even though it's a little bit of a crazy time, it's going to end. And it seems like it's going to end soonerish rather than laterish. If there was a general consensus in the market that, things are going to be terrible forever, those things would have been immediately slashed and changed.
Yeah, so pessimism on the part of mortgage lenders is not good for the market. I had heard, and so perhaps this was not a guideline change, this was just an overlay or something specific to a lender, but I had heard something about FHA requiring more reserves for the buyer to have more reserves in the bank when they close.
Well, it is always good to have more. More is always better. I've not seen that, and I haven't seen it personally. So I personally am doing a lot of volume and a lot of FHA volume. I haven't seen that. There is a way for them to kind of change those requirements without publicizing, making it public. things are run through what's called automated underwriting systems. So for FHA, it's called Total Scorecard. And you submit it out in its electronic system, and it reads all the file attributes and it spits back, yes, this is okay, no, it's not okay. They can tweak the algorithm that produces those approvals or denials. So they can just sort of turn the screws in the back end. They don't have to issue a press release, and you'll see fewer approvals or, like you were saying, more reserves required. I haven't seen that happen. That's not to say it won't happen in the future, but as of even today, the underwriting systems, everything seems to be operating normally. We haven't seen any decisions change that were previously submitted through. So it seems to be pretty stable in that aspect.
All right, good. So for our listeners and viewers, I just want to say overlay is a word that I do not like when it comes to mortgage lending, because I will hear somebody say in a transaction, well, that's the FHA guideline or the Fannie Mae guideline or the Freddie Mac guideline. And then I do my research and I find out, no, that's not the guidelines, but this particular lender has decided when they write those loans that they're going to take the guidelines from the original investor and then overlay their own set of guidelines on top of it, which makes sense. It's their money and they can decide what risks they have. But there's a lot of talk about what the guidelines are that's not necessarily truly the underlying guidelines.
Yeah, I mean, I've bored a lot of people at a lot of different cocktail parties, so I won't get too far into it as to why. But essentially, there is a double speak in the guidelines, so you really have to know them, because you forget, one, these guidelines are public, and two is it's political. The government is involved in this, and they are involved in credit policy, which makes things very funny. So you'll see a lot of times where the guidelines say this. On the back end, when these loans get to be sold, they get audited or something happens. HUD then, the owner of FHA, comes back to us and says, we don't like this loan, it fails this guideline. And then we say, well, here's the guideline right here. It's in black and white. They're like, hey, listen, man, we're the government and you're not. So you end up finding out on the back end, months, years later, that guideline doesn't mean what you think it means, which puts the lenders in sometimes a bad situation where, anyone with eyes can read. It's all out there. It's on the internet, and you can read, hey, it says this. You're telling me it means this. It puts us in a bad spot where you can say, I've been doing this a long time. I've dealt with HUD directly in a lot of issues. They do not mean this. So there's sometimes a disconnect between what they publish and what they actually respond with.
Joe, it sounds like you have a stressful job.
It's a lot like being a lawyer, and it's challenging. It can be rewarding that it's an art and a science, so it does give you a little bit of flexibility to do things you think could be done. But there is a saying that risk is measurable, uncertainty isn't. A lot of what we think is risk is not. It's uncertainty. How do you price uncertainty? How do you defend it? How do you argue for or against it? It's very challenging in that respect. Yes.
What does it mean when the Fed rate changes?
Matt, I'll let you answer that. I think you're a little bit closer to that than I am.
$1 million question, right?
Everyone
pull my
asks.
notes just to make sure I'm articulating it correctly. So right off the bat, the Fed rate does not directly impact the mortgage interest rates. It influences them, indirectly, but it's not. When the Fed says, hey, we're cutting it by 50 basis points or 100 basis points, that does not mean that the rate that I quoted you at 3.5% last week is now 3%. And so that is one of the questions that I get asked a lot. Again, Fed rate, my understanding, is the rate at which banks lend money to each other overnight. And so the purpose or the goal with Federal Reserve lowering the interest rate is to add stimulus to the economy to a certain extent, right? So if it's cheaper for banks to give out credit to, that theoretically, would trickle down to consumers and, who are now buying more products and out and shopping and, creating revenue for businesses. And so when they lower it, that also has an impact on secondary mortgage market and the bond market, which then has more of a direct impact on mortgage interest rates. And so separate interest rates, but they are tied together loosely. And a lot of times we'll see, on a loan officer kind of level, I'll see even an announcement of a potential rate cut, obviously before they lower it to virtually zero. We'll see the impact of a potential rate cut already priced into the rates before an actual cut even happens. And so it's kind of always we're playing catch up by telling people, hey, we've already, no, rates aren't lower than they were last week because we already saw an improvement from the announcement. So that's kind of the idea behind it in terms of the connection.
So I believe people who watch the bond market try to predict how that's going to affect interest rates. I've never fully understood that. But would you say that it's true that pessimism in the market affects the mortgage rates immediately and optimism might take a little bit longer to hit? Like rates will go up faster than they'll go down?
I'm sorry, Matt. It's a lot like.
Yeah.
Oh, we lost your sound, Joe.
Sorry. It's a lot like oil prices, where as soon as something bad happens, you see oil prices change right away. But when supply starts to increase, everyone's sitting around thinking, well, we're actually making some money at these higher prices. So I don't really want to price these things down immediately. Let's hold off and see how someone else does first. And then when someone else does, we'll slowly cut it down a little bit, and then we'll slowly cut it down. But the instant something bad happens, it's like everyone panic, everyone raise everything overnight immediately. So I think that's a little bit of human nature. I'm sure Matt kind of sees that too.
Yeah, I mean, we had a few weeks ago, seemingly overnight, the half a percentage point increase in interest rates for refinances, which obviously created a lot of questions and phone calls on my end of things. Yes, to answer your original question, it's they do tend to go up fairly drastically and quickly versus coming down at a same or similar rate. So yeah, again, overnight, it was Monday evening, I was quoting rates at, between 3 to 3.5%. And then come Tuesday morning when they released the new rate sheets, it was now, 4 to 4.5%. And so that causes a lot of issues with people who are looking to refinance because, hey, great, this is the setup, this is all the numbers, this is what it's going to look like. We've already done the back and forth. I've quoted in the interest rate, which, for the most part, again, not taking the current events into the equation, they stay fairly stable, from week to week. There are, an eighth of a point or a quarter of a point swings depending on what's going on globally and economically and what the perspective is on optimism versus pessimism. But so there's typically not too drastic of a swing, but when you have a half a percentage point, that takes a lot of the potential candidates for refinances out of that market. And so I have a list. I'm sure a lot of other loan officers have a list of people that, we took an application that Friday before or that Monday, and, Tuesday it's now, it's not worthless, but it's, you can't get that same rate. So the refinance no longer makes sense. And I just told people I'll keep them on the list. And if things trend back down, when hopefully we normalize, that's when we can kind of get the ball rolling again.
Matt, how long can I lock a rate in for?
Yeah, so it's a good question. Traditionally, I do 30-day rate locks. You can go down to a 15-day rate lock, and you can go as high, I believe, as 90 days. Joe, correct me if I'm wrong. It probably depends on the investor in terms of what they will allow for a rate lock. I don't usually see 90-day rate locks. 60-day rate locks right now are currently kind of the norm for refinances if you're still able to do a refinance transaction. There is a little bit of a hit to the interest rate. It's less attractive the longer that you lock in an interest rate. Obviously, just because you're locking in either a potential gain or loss for a longer period of time. So inherently riskier the longer you reserve that rate lock. But yeah, the standard is 30 days just because that's about the length of a contract to get a loan in and closed. And that's something that I'll have a conversation with my borrowers with towards the beginning of the transaction, is that, I'm not going to gamble with their interest rate. I keep a fairly close eye on what the market's doing, and everybody does. And so if other loan officers will communicate with people who work with us and my coworkers and say, hey, interest rates are looking to go up, or we just got an alert that we should lock all of our loans. And if that's the case, then I'll reach out to a borrower and say, hey, this is what the current outlook looks like. Do you want to get locked in now? I can, or do you want to wait to see what happens? And some people like to gamble. Some people just want to say, lock it in. And I want to know what my payment's going to be. And so I typically leave that up to the borrower. If we're in a situation where, timing's an issue and if something's going to happen overnight and I can't get in touch with them, then I'll make an executive decision on their behalf and get locked in.
Well, I want to thank you guys. This has been super, super informative. I thank you, Joe, for taking time away from holding people's future in your hands. And I thank you, Matt, for all the education that you give us as realtors and taking care of borrowers and answering their questions. So we hope you enjoyed this opportunity to get real about real estate. Please like, subscribe, and share Spouses Talking Houses with your friends, family, and neighbors. And if you like this show, we'd be very grateful if you would leave a review. We listen to your feedback, and reviews help others to find the podcast. You can find us on iTunes. You can find us on YouTube, Spotify, Facebook, whatever your favorite podcatcher is. So thanks so much.
Thanks, Joe and Matt.
Thanks, Mike.
Thank you also to our producer, Ben.
Music courtesy of the Eric Lindbergh Trio. Please visit his website at www.ericlindberghworld.com. Jennifer and Brian are licensed to practice real estate in New Hampshire and Massachusetts. Brian is also a certified general appraiser in New Hampshire. They are not lawyers, accountants, home inspectors, or therapists. Real estate customs and rules may be different in your area. Each Keller Williams Realty office is independently owned and operated. The realtor name is trademarked to members of the National Association of Realtors. If you are currently under contract with a real estate agent, this is not intended as a solicitation. Views expressed on this podcast by Jennifer may not be shared by Brian and vice versa, nor are they necessarily the views of Keller Williams Realty.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.